Okay, welcome back. Like I mentioned in the first video, this video is going to cover some introductions to trading, introduction to factors that drive different, prices, whether driving the price upwards or downwards. We can also look at a few rules that we need to follow as people who are new to trading. Now, before we even go into any of those, I'd like to remind you of the disclaimer on this video. Like I mentioned in the first video, I am not a certified professional advisor or professional financial consultant. So whatever I provide in this video, it's my opinion. This is in no way a recommendation or any professional advice. Now that we have that out of the way, I'm going to focus on three things that I think are crucial. The reason I want to go through these three things is because these three things are very crucial. Before you go into trading, especially as a beginner, you need to understand what drives prices, for example, because what you see whenever you log into any trading platform, you're going to see prices either go up or go down. There are reasons why these prices go up or down, why they fluctuate, and I will touch on this briefly. Also, I'll talk about just basics of trading, some things you need to know before you start trading. Again, we're assuming that people who are going to consume the information provided in this training or this presentation are people who are new to trading. They haven't read any books, they haven't gone through any training at all, so they are beginners. Then a few rules that you need to follow while you're trading. Okay, so let's look at some factors that drive prices. There are a few factors that will drive prices. So for example, let's say you woke up or when the market opened today, let's look at Amazon for example. Let's say Amazon stock was $3,000, but at the close of the market, maybe it closed at $3,200. Now, something must have caused that. So there are a lot of factors that drive these price swings or movement. Number one is macroeconomic factors. So there are factors like interest rate. Let's say the central bank reduces interest rates. The public might perceive that as favorable, and that might cause people to buy more or spend more money, invest more or borrow more money to invest. So that's a very simplistic example of what can drive the price of stocks to go up. In the case of Amazon, let's say retail jobs or retail numbers came out and the numbers are good, so the public might perceive that retailers like Amazon are going to do well or are doing well. So that's a good indication or indicator. Number two could be company news. So let's say take a look. Let's take an example from the medical field. For example, Moderna. Moderna is, the company that makes the mRNA vaccine for COVID. If you notice that, during, when we're going through a lot of COVID, stay at home, and these companies were investing in technological advancements, and once they got some breakthrough that they were able to provide or produce the vaccine, their stock prices went up. So that's an example of a situation where the market price or the stock price can go up because of positive news. Vice versa, if let's say the public was expecting the company to advance some technology, and if for some reason they didn't do very well, that might cause the price to drop. Company news too could be profits. For example, let's say the forecast is that company A is going to make a profit of $5 per share or something. I'm just making up these numbers. But let's say there's a positive news that earnings per share are going to go up at a certain rate. Let's say the public is expecting the earnings to be, let's say, $2, and for some reasons it ended up falling short of that forecast, and maybe the company did not hit the $2 mark. Maybe their earnings was like $1, in that case, the price will go down. So that's just a simple example of what can drive this. Again, for this presentation, this is really just an introduction. It doesn't really, we're not going to need a lot of these things in the strategy that I'm going to teach you. Another thing is fear and greed. Sometimes, because it works on psychology of people, sometimes the public might hear some news, and because of that, they will be scared and they start selling off their stocks or buying more stocks. That can cause prices to either go up or go down. The other thing too is greed. Some people are very greedy and they can manipulate the market just because they want to make money off the market. Examples of these people are short sellers. But overall, this is just to paint the picture. News, like I mentioned earlier, can drive prices to either go up or go down. Okay, so let's quickly look at some of the basics of trading. Some things you need to know. Trading times, depending on what part of the world you are in. For example, in America, I live in the Pacific, under the Pacific time or Pacific Northwest. And in that case, I follow this time. So for us in the Pacific Northwest, trading starts at 6:30 a.m. That's when the market opens, and up to 1:30 when it closes. So depending on what region that you are in, the times will vary. Also, things you need to know about going long or going short. So if you think that the stock price is gonna go up, you go long. That means you buy. So let's say the stock price is like $2 per stock today, and you think it's gonna go up to $10, you buy $2. Then when it's $10, you sell. Or for people who do short selling, I don't really do short selling, but basically people who short sell, they think that the price of the stock is gonna drop. Let's say the stock is valued at $10 per stock today, and they think it's gonna drop to $2 per stock. They can sell, so they sell at that amount of 10, and when it's $2, they will buy it back. So, but the basic logic is for people who are long sellers is to buy when the price is low, then when the price is high, then you can sell. So you take the margin. All right. So the other thing too that I want to talk about is the price at which you're buying, you're bidding. Then, if a seller who is willing to sell the shares, they give you an ask price and say, okay, this price is currently at X amount. The ask price is going to be Y amount. So it's like going to the market to buy. The price that you're willing to pay is what you bid for. So you can say, well, I'm only willing to pay $2 per stock, and that's what you're willing to pay. So that's your bid price. Then the ask price is what the seller is willing to sell. So if they say, you know what, I'm only willing to sell the stock at $5 per stock, then that's the ask price. Okay, so by way of summary, I wanted to sort of mention a few things that are important before we go into looking at indicators or technical analysis. A few things that you need to take into consideration as trading is about discipline. So that means if there's a strategy that you follow, you have to stick to that strategy. You cannot trade based on your emotions. You say, oh, this thing is going up, or I need to go in, or it's going down. No, you have to follow a strategy. If there's a strategy, let's say you're using an indicator that says you have to purchase when this indicator is at this point, and when it's at this point you need to sell, then that's what you do. You don't guess. There's no guesswork here, right? And if you have a winning strategy, you have to stick to that winning strategy. Number three, you don't need to panic. All right. There are cases where your strategy might fail, so it's not 100%. There might be 1 or 2 percentages or times when the strategy might not exactly work because maybe there are short sellers or there are people who are manipulating the market. But for most times, your strategy is going to work out. So don't panic. That's the point. And last but not the least, don't be greedy. If you're trading, I like to advise people to trade with money that they think that they can lose. So let's say you lose all the money, it's not going to be the end of the world for you. So don't be greedy. If you make, let's say you opened a trade and you made For example, let's say you set a target for yourself. It's target of, let's say, $500 a day. Once you meet the $500, there's no point trying to play around in the market. Take your profit and leave. So that's sort of, these are just basic rules. Again, these are not cast in stone. With time, you're going to become more proficient in the way you trade, and you're going to be able to trade better. All right. See you in the next.